Hey, what's going on everyone? Welcome back to the channel all about real estate. My name is Lewis, and in today's video, we're going to do a deep dive on the FHA mortgage loan requirements for 2022. We're going to take a look at which borrowers are eligible. We're going to talk about down payment, income requirements, credit scores, talk about mortgage insurance, and of course, which property types these loans are eligible for. And if you stay till the end of the video, I'm going to share with you one of the ways I've seen this mortgage product used to help people live for free and generate wealth investing in real estate. Okay, so we are going to jump right into it. I have an article up on the screen from NerdWallet. I'll go ahead and link to that in the show notes below, but it outlines some of the new requirements for 2022 really well. So I'm going to use that to help explain some of these things here. But anyway, the home ownership requirements, one of the things I wanted to mention is that there is a known misconception that these FHA loans are meant for first-time homebuyers. It is designed specifically for those who have less than perfect credit and or a limited amount of funds available for the down payment and closing costs. We know that one of the biggest hurdles for people that are trying to purchase a home today, it's saving up for that down payment. It's one of the biggest challenges, especially in a market where prices have gone up dramatically over the last 24 to 36 months. And then, of course, saving up for the down payment is one thing, but then you do need to have some funds set aside for the closing costs as well, which can add up. But anyway, the main takeaway here is that you do not need to be a first-time home buyer to utilize this, but talk to your mortgage professional or your mortgage broker and walk through some of the benefits, the pros and cons of this mortgage product to see if it's right for you. So now let's talk about the down payment a little bit. With FHA, the minimum down payment requirement is 3.5%, but that will ultimately depend on your credit score. So for those of you who have a 580 credit score or above, 3.5% down is the minimum amount required for an FHA loan. Now, if your credit score falls below 580 and it lands somewhere between 500 and 579, the minimum down payment requirement is 10%. Now, of course, that minimum down payment requirement is based on the purchase price. So just as an example, if you're looking to purchase a property for $300,000, 3.5% would be $10,500 versus a 10% down payment requirement would be $30,000 in that scenario. Now, of course, the down payment section that we just talked about touches on the credit scores a little bit, but I want to do a little bit deeper dive there. So the minimum credit score required for an FHA loan is 500, but I want to note that lots of these lenders out there have their own overlays and they have a minimum credit score that they're willing to go down to. So, and in many cases, that may be 600 or 620 as a minimum credit score requirement. So if your credit is, let's say, under 620, then you're going to have to shop around with like a mortgage broker and find one of those lenders who does not have those overlays, and maybe it is in a position to manually underwrite that file as opposed to running it through what they call the automated underwriting system. But to be clear, per the FHA guidelines, the minimum credit score requirement is 500, but between 500 and 579, that will require a 10% down payment. Once you get above 580, only a 3.5% down payment is required. Now let's go ahead and take a look at the income requirements for an FHA loan. And we'll break that into two categories, one being the debt to income ratio and then the other being the income. So the debt to income ratio, or DTI, is calculated two ways with FHA. First, they have something called the PTI, which is the payment to income ratio, and that's simply the proposed monthly mortgage payment compared to your monthly income. They have a cap on that at 40%. So just as an example, let's say you have a $10,000 per month, that's your monthly gross income. Your mortgage payment at most can be 40% of that, which would be $4,000. Just a super basic example. However, the debt to income ratio includes not only your proposed monthly mortgage payment, but it also includes the other items that show up on your credit report, things like credit cards, car payments, student loans, things of that nature. If you put both of those together, you get what's called your debt to income ratio. And the DTI, the maximum amount allowed with FHA, is 50%. So again, in that $10,000 per month, gross monthly income example, the maximum amount you can get approved for with an FHA loan between housing expenses and other obligations is 50% of that, which is $5,000 per month. Now, moving on to the income requirements, one of the beauties of this product is that there is no minimum or maximum salary amount. So if you have a really high income, but maybe you have less than perfect credit, this still may be a valid option for you. With that said, there are some requirements. So you have to have at least 2 established credit accounts. Generally speaking, those need to be established for 12 months or greater. So that could include something like a credit card and a car loan. And then you cannot have any delinquent federal debt, judgments, tax related or otherwise. And then with regards to cash deposits in your bank account, you will have to source those deposits. Now let's go ahead and move on to the mortgage insurance section. This can be a little bit nuanced and confusing when you're looking at this mortgage product. The main reason is because there are 2 types of mortgage insurance that are associated with an FHA loan. So it's best to separate the 2 so you can get a clear picture of what you're getting into. So the first is going to be an upfront mortgage insurance premium, and that is based on a percentage of the loan amount. So at the moment, the upfront mortgage insurance premium is 1.75% of the loan amount, and that can actually be financed into the loan amount itself. So as an example, let me go ahead and pull out the calculator and we'll take a look here. So let's say you have a base loan amount of, let's say, $300,000. You would multiply that by 1.75%. And that would give you $5,250, and then you would add that back into your base loan amount of $300,000, giving you a financed loan amount of $305,250. Now, this is the same across the board regardless of your down payment, and it just varies depending on the loan size. So if you're purchasing a property for $500,000, that fee is going to be higher. If you're purchasing a property for, $150,000, the fee will be lower, but it always remains relative to the loan size itself. It's 1.75% of that actual base loan amount. Now, after the upfront mortgage insurance is accounted for, you will have a monthly mortgage insurance premium associated with that loan as well. Now, the monthly mortgage insurance will depend on the size of the down payment. So it does vary slightly. Talk to your mortgage professional about that. But in general, if you're looking at putting 3.5% down, utilizing this product to its full advantage, then the mortgage insurance on an annual basis will be 0.85% of that original base loan amount. And then that's paid, of course, on a monthly basis. So I'll pull the calculator back out and we'll do another example. If we still use the $300,000 as our base loan amount, you'd multiply that by 0.85%. And that would give you $25.50. That is the annual premium. So you would divide that by 12. And that would give you a monthly mortgage insurance premium of $212.50 per month. Now, with regards to a 3.5% down payment, this monthly mortgage insurance would remain on the loan until you refinance out of it into a conventional mortgage product. In other words, it never goes away. Now, conversely, if you are putting 10% down, then this mortgage insurance would likely be slightly less on a monthly basis. In addition to that, it would actually fall off after 11 years. Now, to be very clear, depending on your situation, this mortgage insurance premium, both upfront and on a monthly basis, is relatively expensive. So the goal would be utilize this product to help you get into a property, but then, over the next couple years, as you build more equity, as your debt gets paid down, you want to ideally get out of this mortgage product and into a conventional mortgage product that doesn't have these mortgage insurance requirements. So the FHA mortgage product is designed for you to purchase a home to live in. So that's one of the requirements, is that you have to intend to live in the property, and at minimum, you're supposed to be there for 1 year. What is really cool and unique about this mortgage product is that it works on almost any property up to 4 units. So it can be a single family home, it could be a townhome, it can be a condo, and then of course it can be a duplex, a triplex, or a fourplex. And it still has a minimum down payment requirement of 3.5%. So if you think about that for just 1 second, let's say you are in the Sacramento market like myself, and there are areas where you can buy a duplex, a triplex, or a fourplex. This is where I've seen this mortgage product being used super effectively, and it helps people generate a lot of cash flow, helps them live for free, helps them build wealth long-term in real estate. Let's say they find a fourplex in Sacramento, California. It's a good area. They're willing to live in the property, and they go ahead and purchase this property for $600,000. and they put 3.5% down on $600,000. That's $21,000. So that particular borrower or investor is able to purchase a $600,000 asset or property. They're able to control the asset that's worth $600,000. They're able to get into that property with as little as $21,000 down, and then they get access to 3 streams of income. Just as an example, let's say in total that property costs them about $3,500 a month to operate, and let's say each unit rents for $1,200. $1,200 for 3 additional units, that's $3,600 a month in income. They are effectively living for free in that 4th unit. They call this house hacking. It is an incredibly powerful tool. And I think that especially for people who are just getting into real estate investing, or they're younger and they want to purchase their first house or an investment, this is an incredible way to get involved in the market. Now, I want to be clear, this house hacking strategy is not limited to just someone who wants to purchase multifamily. Let's say you have a super ambitious millennial. They are working really hard to save money, but they want to figure out some way to house hack, but they don't like the areas that the duplexes or the fourplexes are located in. They'd much rather buy a home in a residential neighborhood where they think that, they'll have better resale value or more appreciation down the road. What you could do instead, or what you could consider doing, is you purchase a home using an FHA loan, you do the 3.5% down payment, and then you rent each room. If you find a home that maybe has 4 or 5 bedrooms and you're willing to live with roommates, you could maybe get, $500-600 a month per bedroom. And if you have 4 bedrooms rented out at $600, that's $2,400 a month that can be applied directly towards your mortgage payment, and that'll lower your monthly expenses, put you in a position where you're maybe not living for free, but you could certainly subsidize your living expense, which for many of us, that's our largest expense that we have to deal with on a monthly basis. All right, well, that is going to wrap it up for today's video. Thank you so much for taking the time to watch. I hope that you found this information useful. Please leave your comments below. What do you think about house hacking? What do you think about the FHA mortgage product? And if you haven't done so already, please consider hitting that like button and that subscribe button to see more weekly videos on finance, real estate, and investing. Again, my name is Lewis. Take care.